We are extremely fortunate to have Tom Hoenig with us tonight, and I think the thing that I'm particularly pleased about and that I'm going to be listening for with great interest from his talk is that although he was as involved as anyone in the financial crisis that we think of as beginning 10 years ago, he is really bringing a much longer-term perspective. And I will leave to him to explain precisely what he means by the title, A 30-Year History of the Financial Crisis, but I think that he means to suggest that it is not just a question of the last decade, but indeed of much of a longer time frame, which is probably as long as many of you are old. So please join me again in welcoming Tom Hoenig to GW.
Well, first of all, thank you all for coming this evening, despite this weather. And it's a pleasure for me to be here. I want to thank Jeremy for the opportunity to speak to you, for the invitation. And I also want to acknowledge and thank Wilmer, who I've known for some time and who shares many, if not all, my views on the issues of too big to fail and the financial industry that we are so dependent upon. The month of September, of course, is known for the trigger date of the Lehman failure, which in many people's minds triggered the Great Recession. It has been debated intensively, not only over the last 10 years, but over the last 10 days probably, as to whether it was something that had to happen, that it had to be allowed to go into bankruptcy. It shouldn't have been allowed to go into bankruptcy. We could have avoided the Great Recession. We couldn't have avoided the Great Recession. And on that debate is and will continue for some time. My point this evening will be to tell you that from my perspective, and this is my view, Lehman Brothers was the exception that proved the rule of too big to fail. It was allowed to go to bankruptcy, but nothing after that was allowed in that sense to go to the same degree into bankruptcy. And I doubt that anything forward, given the change in the structure. And that's really what I want to talk about. The idea of too big to fail for these institutions have been weaved so tightly into the financial fabric of the U.S., maybe the global economy, that to try and pull that thread out would, I think, rip the cloth of the financial system. And that's my point. And it didn't happen just in 2008. It is something that has taken decades to find, and that's what I want to walk you through. Before I actually begin the conversation, you do have handouts in your hand. I'd like to just have you look at those briefly. I will describe them for you, and then I'd like you to put them down, and then we'll engage in the conversation, because I want them in the back of your mind as I talk about events that take place over these many years. The first chart is a chart of real interest rates from the early 60s, or from 1960 to almost the present. And it is a description of the rate relative to the long-run growth rate, real growth rate in the U.S. economy. And I use that as kind of a tick mark for what I would judge neutral, tight, or easy policy. And you will see that for most of that period, the long-run average is a little above 3%. Most of that period, the real policy rate is below that. It's designed to be modestly stimulative or stimulative over that period, with exceptions when inflation is of real concern. But that's because in the U.S. economy and in much of the global economy today, a little inflation is thought to be good. It helps accelerate demand and therefore is thought as a very desirable thing. In fact, the FOMC's target is 2%. And that has carried the day. But you look at that chart, you'll see that many times it's much lower than that. And that I will come back to in a moment. The second chart I want you to look at is the dramatic change in the structure of the banking system in the United States. From a very decentralized, distributed banking system to the one that is much more highly concentrated in today's world and only increasing. as we go forward from here. So it's a dramatic change in the structure, fewer very large institutions, and it is in that context that we want to think about too big to fail, because too big to fail was introduced well before today, and that's important. The last two charts are the same thing said differently. That is, if you look at today's world, the largest institutions now touch more financial assets than ever. It's not just its balance sheet or their balance sheets. If you look at their balance sheet, they're large, over $1 trillion systematically at those largest institutions. But then you add in their derivatives book, which adds substantially more assets and risk that's off balance sheet. Add their trust that's under their management and care. And then add the safekeeping that they hold for others. If you look at that, you can begin to see that they are of dramatic importance today compared to other periods. And the last chart only says that differently and compares our largest institutions to the US GDP. And they are substantially larger than our GDP. So too big to fail has been weaved very carefully into the fabric of the US financial system. Now I want to go through and just talk to you about that process over the decades. And I break it up into three periods. The first period is those events that led to the first banking crisis post-World War II of major significance. The second period is what I call the capital markets period, where we bailed out the capital markets as the industry and as international events dictated. And the third, of course, is the universal bank period, in which we had the 2008 crisis that carries on to today. And looking at the first period, that is the banking crisis period, I think it's important now to think about that interest rate environment, because you had an accommodative policy through most of the 70s. As Jeremy said, we left the gold standard behind entirely, and we began a fiat currency that gave the central banks and the central bank of the United States much more flexibility to conduct monetary policy in an accommodative manner, which it did. And over that period of the 70s, inflation creeped consistently upward, both in goods prices and in asset prices. It became so that we expected only inflation to continue. And therefore, decisions were made on the assumption that inflation would continue. That is, banks loaned on the assumption that the asset values will only increase. How can I lose? It included energy because of the embargo that was spoken of, and the fact that loans were being made on energy at that time that was $50 on the assumption that it would be $100 without much time passing. Loans were made on real estate, commercial and otherwise, on the assumption that the value of the asset would increase while the construction was in place, so that you would have loan-to-value ratios that were much higher at the end of the construction than at the beginning. And of course, in the agricultural sector, they don't make land anymore, so loans were being made against asset values without any regard to cash flows that might come off of that. So you had this momentum, this easing of underwriting standards, this movement forward until we had major lending and activities that went forward from there. Now, with that inflation rising to 13% in the United States, which was unheard of in peacetime, people began to get concerned. And Interstage left in that scene as Paul Volcker, determined to break the back of inflation, which he did, but at significant cost. Because interest rates went from 7-8%, most under the Fed funds, to 20%. It caused a major implosion of asset values in a very short period of time. It changed the dynamics of that industry dramatically. Now, we had S&Ls and commercial banks, tremendous stress on those institutions that had fixed assets for 30 years against very short-term funding that suddenly became, you couldn't find it any longer. The S&L industry cost the U.S. taxpayer in dollars at that time well over $100 billion before it was over. And I'm going to set that aside because I don't have a lot of time. And I want to talk about how we came to the first use of too big to fail after World War II. And it began, surprisingly, in the 10th District, which I was involved with in Oklahoma. You had a bank, a relatively small suburban bank, that really was one of the first originate to distribute systems that caused havoc later on. This bank that was only $26 million when it was acquired by this group soon became $500 million in size. But more importantly, it had originated and sold billions of energy loans and related to upstream banks. Several, Chase for one, others, but one in particular, Continental Illinois. Continental Illinois was the 7th largest bank in the United States at that time, so keep that in mind. So in June of 1982, the end of June of 1982, I was in charge at the Federal Reserve for the discount window, the lending facility. And in the middle of that week, I got the phone call that said, Houston, we have a problem. This bank, this suburban bank, now $500 million, up from 20, was having funding problems because with the pressure of Paul Volcker tightening the policy, energy wasn't going up any longer as it was before. Demand was falling off. They couldn't fund their loans any longer. They needed liquidity assistance. During the first part of that week, we loaned them money just to get them through so we could find out if they were in fact viable. And in that instance, over the 4th of July weekend, a 3-day weekend, our mission was to put in there and look and say, is this institution viable? Not, and this is important in today's world, not did they have enough collateral that we could lend against. We thought we could find it, but was it viable? And the conclusion of that, by the control of the currency and us, was no, it's not viable. So we refused to lend any further. The bank was closed that weekend. Now, that's extremely important in the following sense, that it was closed and millions of dollars of uninsured deposits were lost to those depositors. And the backlash from that, how could you allow this to happen, was enormous. There were hearings on it. This bank was allowed to fail. These people lost their money. Someone has to be blamed for that. That's important because it changed attitudes as we went through that crisis. So now you go forward 2 years more to 1984, and you have Continental Illinois there. Continental Illinois was one of the banks that bought all those loans from this little suburban bank in Oklahoma, and it was in deep trouble. And in fact, it was known that it might in fact fail. Now the dilemma was, do we allow all these uninsured depositors in that bank, the 7th largest bank in the United States, to take a loss? And not only that, but that bank borrowed what was called overnight funds from downstream community banks, hundreds. Are we going to allow those banks to take those losses and maybe fail themselves? And there we have a systemic bank problem in the community bank arena. How do we deal with this? And the decision was made by the Treasury, the Federal Reserve, and the FDIC that no, we couldn't let that happen. And so the holding company was pushed aside, but the bank and its creditors, its depositors, were spared. Thus, we introduced too big to fail into the post-World War II system. Thrifts failed, other banks failed, but large, important institutions were not allowed to fail. And it set the standard for some time to come. Now, following that, of course, we had new legislation, and that's important relative to today. We had FIREA and FDICIA, and in the Senate documents, there's clear statements. This now will end too big to fail. These laws will change the dynamics. We will no longer have too big to fail. It's a done deal. So we move forward. We move from that period of the 70s, the 80s to the 90s, and now we have the capital markets ascension of importance. Because the banking industry fell behind, now we have the capital markets, the largest investment banks, and we had a new environment. Now we had emerging markets, we had fixed exchange rates, we had NAFTA, new trade, opening up markets, real growth, and the capital markets were there to save the day. And over that period, there was enormous numbers of dollars that moved from the United States into countries around the world. Asia, South America, Mexico, and so forth. And that went on, and growth in these countries went on. They had very significant growth spurts, lots of dollars flowing in, until people began to wonder if, in fact, that could continue. And confidence began to be lost, and then we had a series of crises. We had the Mexican peso crisis, we had the Asian crisis, we had the Russian crisis, we had the LTCM, that is long-term capital management, that was an arbiter of that crisis. We had this going forward, but here's the difference. And I'll use the Mexican peso crisis as the example, but it's similar to the others, only different players intervening. So there you had NAFTA, real growth, you had fixed exchange rates, and the demand for dollar-denominated goods coming in was great. So over time, though, the imbalances started. The deficit started in their country, and you had beginning to lose confidence in the peso. And so then dollars started to flow out, and suddenly the central bank, or the government of Mexico, was issuing what's called tesobonos, which was debt and denominated in dollars with a promise to be back in dollars, so that they could continue to support their currency, being provided by the capital market players in the United States, that is the largest investment banks. Okay? So they had these dollars over there on the assumption that they would get those dollars back, and now we were in trouble. So what happened? Did we let them go and default on their loans? No. And open market committee meetings and in others, there was a very strong concern of what the fallout would be on the United States, because Mexico was going to suffer regardless, but on the United States. And so under the Exchange Stabilization Fund, which was set up for entirely different, dollars were provided to Mexico to get them through the crisis, which bailed out U.S. capital market players. So too big to fail took a different form, but here's the difference. This was judged enormously successful, right? Liquidity was provided. No one asked what would have happened had that not been, what would they be solvent? But liquidity was provided, and it was enormously successful. This happened in Asia. Now, the events were the same. The country suffered greatly, but the U.S. capital markets were spared because IMF intervened, provided the capital. Maybe not the U.S. Treasury, but IMF, which is supported pretty significantly by the U.S. And so you had this, again, too big to fail, this ability to provide liquidity or funds. In essence, you can't distinguish at that point liquidity from capital at that point coming into the market. But that was judged successful. So second instance of too big to fail and the government intervening that sets too big to fail further into the fabric. Which then leads to the very wonderful event that said, well, it's been so successful, we'll have a more competitive market if we allow commercial banks who are supported by the U.S. safety net, that is the discount window and deposit insurance, to engage in these other activities, like derivatives activity, securitization activities, setting up special enterprise off balance sheet with lines of credit so you could expand the market infinitely large, and of course the risk will be taken care of somewhere else, which is primarily means the taxpayer. So that went on, and the expansion was enormous. And in fact, it was so successful, and they were so convinced that the market would solve all problems, that when the head of the Commodity Futures Trading Exchange, Brooksy Bourne, tried to put some kind of boundaries against derivatives, she was yelled off the stage. Yelled off the stage. It never happened to pass laws to prevent that from occurring, and so the risk only mounted. So that goes on until we finally have 2007, 2008, and someone begins to say, this doesn't look like this mortgage market is all that great after all. Confidence is lost, and now you have the first bailout, Bear Stearns, goes from there. They say no to Lehman Brothers, chaos breaks loose, they said yes to everything after that, whether it was city, AIG, so forth. So now too big to fail is confirmed, absolutely confirmed in the marketplace. Now, we have Dodd-Frank. Just like FIRREA and Fiducia, this is going to take care of the problem.
And too big to fail, right?
We're going to end too big to fail, it's been taken care of. But the fact of the matter is, if you look at this, if you think about it, the fact that there's two provisions in that law, called the living will provision and the Title II, where the government can come in an emergency, that to me institutionalizes too big to fail. And I will tell you that even if you were to repeal those two titles, you still have too big to fail. There is no president, no secretary of treasury, no chairman of the Federal Reserve. When you look at the last charts that I showed you, where one failure will bring down the entire economy, will they let that go? Without a fundamental change in the structure, too big to fail is now weaved so tightly into the cloth of the financial system globally that to try and pull that thread out will tear the fabric unless there's a change, a significant change in the structure. And that's really what I think is so important. Because what we're doing now is we are saying too big to fail has been solved when it hasn't. And that leads to the worst outcomes you can imagine. Because it allows to argue, as we see today, repeal of any kind of strong capital standards, which are important, paying less attention to the liquidity issues, backing away from important fundamentals. You can change, you can say, this time it's different, except for fundamentals. Fundamentals do not change. And that's really the challenge we have. So my point is, too big to fail is still with us. We can argue about Lehman's as long as we care to, but too big to fail is now part of our life, unless we change some other fundamentals. And for that, I also make a plug. Art is working on a book that describes that transition even more so, and it is, I hope, a guide for the future where we can address a very important problem. So I'm going to stop with that, ladies and gentlemen. That's the history, the 30-year history. It's not just one crisis. It is a series of crises that leads to some pretty, I think, scary outcomes. So let me stop there, and then we'll have questions, I hope. Thank you all.
And I neglected to introduce, along with our speaker, Professor Arthur Wilmarth, who will start the Q&A and then moderate the discussion. As Tom Honig just said, Professor Wilmarth is not only a great expert in contemporary banking regulation, the Dodd-Frank era, but an expert in the entire 20th century history of banking regulation.
Well, thank you very much for coming. Let me join my welcome, and thank you, Tom, for being with us. Tom is really one of the, I believe, most courageous, most well-informed voices, because unfortunately, these institutions, as you can see from the charts, are incredibly powerful. They're incredibly influential. They spend more on lobbying than any other group in town. They spend more on political contributions than any other group in town. They are used to getting what they want. I think one reason that Dodd-Frank was as weak as it was is that the industry, even as wounded as it was, had enough strength to push back and prevent even stronger legislation. And then they convinced Congress, of course, to put a lot of it into rulemaking. In other words, don't put firm standards in the statute, allow the regulators to work it out, implement it. And so, of course, once it got to the agencies, then they were able to influence the agencies. Well, don't be so tough. And then, of course, even where the agencies were somewhat tough, now that's being rolled back. And Tom has really been one of the few senior regulators who has been unafraid to really speak the truth, to speak truth to power. I think he deserves a tremendous amount of credit for being as bold and outspoken as he has been in saying, look, we haven't solved the problem. We have not changed the basic financial system, the basic financial structure that brought us this crisis. We have not done what Congress did in 1933 after the Great Depression when they said, we know that the universal banking structure that brought us this crisis is fundamentally flawed, and we're going to say, banks, you're over here, capital markets, you're over here. We're not going to combine the two. We're going to make sure the federal safety net only protects banks, does not protect the rest of the markets. We did not do that in 2010, and so we're facing, in many ways, the likelihood of a repeat with many fewer bullets to fire in the next crisis. I'm going to ask Tom a few questions myself, and then I'm going to invite, obviously, questions to the audience. One thing that struck me, Tom, as we look back at this, looking at 2007 in particular, how slow most of the regulators were to sort of understand how serious the problems were. And there's a very interesting conversation that we were mentioning before your speech that took place at the FOMC in October 2007. At this point, the crisis has not become fully blown wide open, but Merrill Lynch has reported a very large loss. Citigroup has reported a very large loss. Both presidents have been replaced. Morgan Stanley has reported some serious problems. UBS, a big Swiss bank, has reported some serious problems. And during this FOMC meeting, this is all in the public record because the minutes have been released and the exhibits have been released. There is the results presented at a senior supervisor's review of 11 major institutions at which major problems are revealed, major risk management problems. And Tom and a few other of the Federal Reserve Bank presidents sort of say, this is very troubling. We have not been told, none of these banks were in your district, so you weren't looking at them. We've not been told that these institutions were in trouble. In fact, we were told quite the reverse. These institutions were supposed to be really strong and in good shape, well above regulatory requirements. And Tom and others, really said, we better dig into this and we better do some real stress testing to figure out, where these institutions stand and how serious it is. And looking at the transcript, my sense is there's not much of a response. What was your perception as to what the senior folks really thought about the kind of fragility and vulnerability of the biggest institutions at that point?
I think that the facts were that we have long changed how we examine these institutions. It's called a risk analysis, which looked at their policies and procedures rather than their ledger and their note case to sample the quality of the asset in place. And so they were operating in ignorance. In other words, if you don't know something, it's hard to form a judgment. And they were getting reports from the industry that everything was fine.
And just deferring to those.
And deferring to them. And number one. Number two, we had not formally adopted a risk-weighted capital measure, but we were relying on that more. We, the United States, and then certainly Europe and others. And this was a method of weighting your assets yourself.
Right.
Right? And we would assign risk, but 50% risk value on an asset. And therefore, the capital numbers being reported were high.
Inflated, yeah.
And we weren't using a straight leverage, that is, how much capital you have to your assets. We were looking at how much capital you have relative to what we think are risk-weighted risk assets, which we happen to think there aren't very many of because we're doing the weighting ourselves. So you have this unrealistic view of how much capital you have. And so not knowing what the asset quality was, not opening those CDOs and seeing what was in them, and then saying we had better reported capital than we actually possess, we were assuming the best when we should have been assuming.
And many assets have been pushed off the balance sheet into conduits and SIVs and these other
I think that's a
exotic
very
structures.
important point. And here's what's important there. They've been pushed off the balance sheet for these so-called special purpose vehicles. But they then gave lines of credit to these special
Guarantees,
purpose vehicles that's that Maine, they were still liable for it. And so we were looking at them, they weren't really looking at them that carefully, and it was just something out of control, because the assumption was only values go up.
So an interesting question is, to what extent has, because you've been very outspoken saying we need to go back to transaction
Right.
testing. And I know with community banks, I mean, people go in and look at their loan files. They look at the appraisals on the commercial real estate. They look at to see whether the loan agreement was properly executed. But to what extent have we actually gone back or not gone back to transaction testing of the major financial conglomerates today?
Well, we're still relying on the risk approach. There are samples drawn, but I think they're relatively small. And so I think we have not gone back to what I call pulling a
Robust.
useful sample that you can then judge, and actually going in and doing the credit on those. And they've actually moved away from that. There's a program called the Shared National Credit, where you take the largest loans and that are then farmed out to other banks, and you actually look at those loans and open the note case. That's been kind of scaled to a continuous evaluation process, which reduces the sample, I think, over time. So I think we're going the wrong direction.
And leveraged loans now are becoming a really big issue.
Leveraged loans have become a larger part of the portfolio. And now there are standards under that, but those are guidelines, and we know the guidelines are not enforceable. So it's really up to the bank and their judgment. And of course, if you are convinced, if you're a creditor and you're the one providing the credit, whether you're a depositor who's absolutely convinced they're not going to lose their money, or another type of creditor, and you are convinced that the government will step in, you don't monitor that risk, and that bank can take on a greater risk, leverage loans and so forth, or importantly, can loan to the hedge funds that are doing the transactions behind that.
Right, they can say,
Right.
well, take our assets off the balance sheet, but we'll make you the loans to let you take the assets off
Exactly,
the balance sheet.
exactly. So that's what worries me in today's world.
The other issue I think that Tom has been, so I think the idea of robust, strong supervision has been one of, your real keynotes. And the other one has been capital. And, now Dodd-Frank, did increase capital, and Basel III increased capital somewhat.
Yes.
But we see that capital, particularly leverage capital, which as Tom said is total capital versus total assets, no risk weights, that it's sort of built up to about 2016 and then kind of peaked and then even has gone down. So now the last 2 years, how much have regulators allowed banks, the big banks, to pay out of their earnings to either shareholders as dividends or stock buybacks?
Well, let me start with the last part of your question. In 2017, they were permitted after the stress test to pay more than 100% in the aggregate of their earnings out to their stockholders, and either buybacks or dividends. So there's been a real attitude that there's enough capital in place. That's number one. Number two, I would tell you that I have always been, I'm a strong advocate for much higher capital levels. Because what Dodd-Frank has done, it has given us a kind of a regulatory process that substitutes for capital. In other words, we're going to do living wills and we therefore have confidence. I'm much more market-oriented in the sense that I would have capital levels much higher, levels that were in place prior to the safety net, prior to the Federal Reserve, prior to the FDIC, where they had 12 to 15%. And therefore, I would let them do more of what they choose, because now their stockholders have more risk. And believe me, that changes your incentives and your attitude. So I think that's extremely important. What their levels are now is about 6% of their assets, their tangible assets. The tangible capital is about 6% of the tangible assets. That's the same amount of losses in 2008, plus the capital injection from the Treasury. So it only absorbs the losses that happened in that very severe, but there's no recap. That doesn't include enough to recapitalize you. So we're better capitalized, I always admit that. but that's not the same as adequately capitalized. And I think.
And they're trying to push back on that.
Right, but I say when you're adequately capitalized, you should have more freedom to take risk, because now you're on the hook for it, not the taxpayer.
Right, right.
And that is, when you have a subsidy, which the safety net is a subsidy, it's hard to give up that subsidy. And that's really what's behind their pushback.
So I think the big banks now are paying usually less than 1% on their deposits overall. I think I saw something indicating that Goldman Sachs is offering the magnificent sum of 1.5% on their online bank called Marcus. But the article was in the Financial Times today, pointed out that the cost of their normal bond funding is 3.86%. So that shows you the subsidy. They go to the market and issue bonds, even though they're clearly too big to fail. So that's a discounted number. 3.86% for bonds, 1.5% for even their highest deposits. That's the subsidy, which they don't want to give up, they want to expand.
And that's why you see, I think today you're seeing more and more announcements of expanding branch operations among the largest, because it's a very low-cost source of funding, and they're in the best position to take advantage of that in terms of the breadth of activities that they can use those funds for, from lending to some of the derivatives book, and even their affiliates, that is, their broker-dealer affiliates, are in that too-big-to-fail group, and therefore it lowers the cost of funding as well.
So my last question before I turn it over to the audience is, looking at these giants and you know, the four biggest banks are $2 trillion or more. Morgan Stanley and Goldman Sachs are around $1 trillion. You know supervision and management probably better than almost anyone. Do you think it's humanly possible for even the best, most vigorous financial regulators to supervise institutions of that size, or for managers to manage them? Is it possible to really run these institutions in a way that is reasonably safe and sound?
Well, there's obvious diseconomies of scale.
Right.
With something that large. I think it is a monumental task. There are ways that you might be able to do it, but I think it's a monumental task to do it. And my point again is that I think that would be, if you had the right amount of ownership at risk, that would be determined how big you can manage. Because if you have repeated losses, the investor community
It's not going to put more capital.
they're not going to
in.
put more capital.
Citigroup, would you put more
They're
stock in the
gonna
Citigroup?
force it. They're going to force a correction. But when you have the subsidy, you can't really determine that. And so I don't know the answer.
What the efficient size is.
Right. And I don't know the answer to it because
We haven't given it really a market test, have we?
Right. I'm afraid not. So. And one other thing I want to say, and that is, people have said I'm really against what I very much want the U.S. banking system and large banks to be successful. And what I've argued over and over again is the U.S., relatively speaking, is one of the better capitalized industries. And they are taking market share in the world, because who do you want as a counterparty? You want the strongest. And so my point is, equity can get you a return. The problem with the subsidy is it distorts the pricing of the product. So you're not pricing the product right because you have a subsidy. Therefore, to get your ROEs up, you depend more and more on the leverage.
Yeah, right.
And there you get some of the worst outcomes. The incentives are distorting the safety and soundness and the effectiveness and efficiency of the whole industry. That's my concern.
Yes, I mean, you're saying right in terms of whatever critique we might have of big U.S. banks. If you look at big European banks, they're a much more wounded bunch. Right?
They are, and they're not, in my view, focusing on building the equity count. We'll
At this point, let me open the floor to questions. Tom, I will let you call on people as you like. That would be fine. If you have a question, just put up your hand. Yes.
Sir, my name is William Bean. I have a concern, and that's that you mentioned subsidies as causing mispricing, which leads to a loss of capital. My concern is that debt itself causes mispricing, because the more you can borrow at high leverage, you drive up home prices, car prices.
Oh, yeah.
And so then even if you had a 50% capital cushion, if prices fall 60%, now you're underwater.
Oh, yeah, I mean, leverage is a killer. I mean, and the subsidy encourages the leverage and the pricing around that, and so you don't know what the downside is, and whether you have enough equity under those certain, I don't know. And that's why, the transition back to more equity would be slow. I mean, going from, when that crisis occurred, there was less than 3% equity.
Real equity, you're right.
And over 10 years, we built it up to 6%. And there's still this enormous leverage out there beyond that, and so you know how long it's going to take. And it's like, even like monetary policy. If you have an equilibrium here, and you want a new equilibrium here, it's not painless. It's not painless. And how you get there is really the hard part.
One interesting point is that through the leverage loans and so on, it seems as though the leverage is now spreading into the corporate sector from the financial sectors, which is pretty worrisome. Right?
Well, I mean, that's absolutely, I mean, leverage is a wonderful thing in ROE, except when it's not. And then it's a disaster, because when you can't fund it, things fall apart. As we've learned, we tend to learn over and over, but who was it? Were you telling me?
Upton Sinclair made a famous comment, which was, he says, it's very hard to make someone understand something when their whole way of life depends upon them not understanding it. It's a great quote. And it was directed at Wall Street.
Yeah. Well,
Right.
we forget. We all forget.
Other questions? Yes, Sunil.
So it's looking at the discussion that's taking place in September about leaving anniversary and discussion of financial stability. So one thing strikes me is that the discussion has been entirely in the context of the financial sector. Now, the financial sector and the financial sector balance sheet is in many ways a derived balance sheet. Right? If your corporate sector is not healthy, or if your households are not, balance sheets don't look good, and so on and so forth, you can't eventually have robust financial stability. Right? If I look at it now, households are much more stretched in the US. The government deficit is much higher, the government debt is much higher. So with the household and the government highly stretched, emerging risks in the corporate sector, especially in emerging markets outside the US where some of the banks may be exposed. But purely a discussion in terms of the financial sector, it may have a little more capital now than it had earlier.
Right.
It doesn't give a lot of confidence that in the long haul, that this financial stability will stand if the real sector really gets sick again.
Your point is well made, and one of the reasons I gave you the first chart is to say your institutions are subject to the macro environment that you create for them, right? So if you engage in a monetary policy that is systematically biased towards ease and inflation, and your target is 2%, which devalues your currency over a generation pretty significantly, then the consequences of that will be paid at some point. If you have a fiscal policy that is highly deficit-oriented, as ours is, and as the world's is, then you will have a very dear adjustment later on. And if you build your equilibrium around a very easy monetary policy or very substantial, then going to a new equilibrium will be very, very difficult and painful. I think that's extremely important to remember. Now, here's the other part of that, though. I think that we always look for the financial crisis. That's, it's going to happen, that's the worst thing. But over a generation, the worst thing is that you move your growth rate from a long-term growth rate of 3% to a long-term growth rate of only 2.5%. Not 1%, but only 2.5%. Loss in wealth for that nation is dramatic over a generation. And that's really what we're risking with this. We will have, in capitalism, you always have cycles and you always have moments. And now those moments are becoming more volatile perhaps, right? Or
Bigger.
spreads are the bigger they are. But behind that is this slowing in long-term growth. I don't call it secular stagnation, I call it deliberate undermining of your economic ability to grow because of your short-term goals. And how you get a generation of people to think longer term when, with all due respect to many of our legislators, when it's not understood by them or by many of us, is a huge challenge, and that's what we face. I think it's been pointed out by many people now that if our deficit continues as it is, our interest payment will be larger than our defense spending very soon.
Which is not sustainable, right?
It's not sustainable.
Other questions?
Can I ask one more question?
Yeah, sure.
Given that I'm in a law school, I should ask this. I just started reading Jesse Eisinger's book, which won the Pulitzer Prize last year, but it's called The Chicken Shit.
The Chicken Shit Club. Because people were not prosecuted, right? No prosecution.
Oh, yes, there is.
So, and the issue is to, and I don't have the perspective that you have. So the question I'm asking is, what was it about the tech crash and then Enron and the others that led to the legal system not
Not prosecuted.
being shy to prosecute individuals rather than settling for cash payments, which are eventually borne by the stockholders rather than the manager, the senior managers of corporations connected to it?
Well, I don't know the answer to that because I really don't know what went into the thinking of why you would not, now, there's a lot of, stupidity is not a crime. So you got that part, you got to take care of it. There was a lot of stupidity, right? So then the fraud, getting to the issue of the fraud and finding that, I think people just didn't have the willingness to engage in that. Enron was, by the time it busted, it was so obvious.
And WorldCom, same
And
thing.
WorldCom, the same thing. But now, there were people in some of the banks that were going down. Seems to
Well,
work
that's
that
good.
way.
They've prosecuted
Yeah.
some small bankers
Yeah.
and put them in
It's so
jail.
easy to prosecute small bankers.
Wilmington Trust just, within the last several months, they sent 3 executives to jail for doing loan fraud.
Yeah.
But Angelo Mazzillo, he wasn't a target of interest. Kerry Kellinger, not a target of interest. And my view is, they didn't even bring civil cases and try them.
Right.
They brought a couple cases and settled them. But
Right.
why would you not bring civil penalty cases against these
For that
people?
kind of
Right.
negligence.
Right, and that's all you have to prove.
Yeah, it's
Right.
not a crime, at least it is negligence.
Right, right.
But
I'm
I don't
sure,
know.
you regulated more small and mid-sized banks, but I'm sure the Federal Reserve of Kansas City brought a lot of civil penalty actions against
Absolutely.
negligent directors.
Well,
officers.
negligent and worse.
Right, gross negligence, recklessness, right. But I think, it's interesting, there was a conversation I was in recently, and they were trying to say, what accounted for the rise of populism both here and in Europe, and the audience was asked to sort of weigh in, and the 2 things they said were bailouts and no prosecutions. And that seemed to be a very widely spread view, that there's just this popular anger that the people, there was no accountability.
Well, that, and then you see and you read about and see the distribution of income as a result
Right.
in terms of the bailouts and not just the bailouts of the payment, but in the bailouts of the low interest rates
Right.
that favor assets.
Which pushed assets up. I mean, it is very interesting that Roger and Rajan and others have said, that one reason that we sort of end up where we were was that real incomes were not rising from about 1973 on, or rising very slowly for anyone below about the 80th percentile. And even below the 90th percentile, pretty modest rises. And that how are you going to maintain consumption except by allowing more credit? And Greenspan himself said after the dot-com crash, we've got to push down interest rates and pump up the mortgage market so they can take out home equity loans.
Absolutely. It was one of the solutions to the demand problem after the.
And there was seemingly no understanding that, well, eventually don't they have to pay these loans back? I mean,
and history, I mean, this is not new stuff. I mean, this is.
It is a 30, 40-year
150
story, as you said,
yeah.
right?
But the idea of the effects on the distribution of income, the effects on consistently abnormally low policy, on asset values, that's been
Been known, right?
been known and spoken about for over 100 years, and yet we forget it conveniently.
Other questions that people want to ask? Yes.
Yeah, David, how could factor the rate of the crisis, and can they be resolved, and what happens to the housing market to make them go away?
Well, they were a big part of it. They engaged through their leadership in some pretty, I'd say, unhealthy, financially speaking, transactions in collateralizing and securitizing loans, and really introduced it to the industry more broadly. So they were a contributing factor in a big way. What can we do about it? I think it is a big question, because it's been 10 years and they're still owned by the government, which frankly, I never thought for a moment that they weren't guaranteed by the federal government. It proved to be the case. So I don't have much sympathy for the equity holders in that, who want to get reprivatized with that guarantee. So I don't know what they're going to do. Now, if they were to abandon it, there's been various proposals put forward, but no one has the appetite to dismantle Fannie and Freddie.
And you need probably a government guarantee if you're going to have either 15 or 30-year mortgages,
Absolutely.
right? The industry won't make those mortgages without a government guarantee.
Well, I don't know how they can, but.
And then the question is, how do you price that guarantee? You're pricing catastrophe
Well,
risk,
it's-
right?
And it's going to be a subsidy automatically, which is going to be installed. But that's why it hasn't been resolved. Demands too much of us.
But they're still off balance sheet. We made sure we only own 79.9%.
Oh, yeah,
so they're still
they're
off
off balance sheet. They're off our balance sheet.
Off-
That's why it was,
off
that's
US
why it was
balance
privatized to begin with,
Yeah.
to keep it off the
During
balance
the
sheet.
Vietnam War,
Right,
right. Really?
I'd like to ask you a question that's kind of a twist on the title of your talk. The title was a 30-year history, but of course your own experience as a banking supervisor and regulator, so it's 40-plus years. Your economics PhD means that you studied earlier periods, so you have lived through and studied and been an active participant in multiple financial eras, if you will.
Mm-hmm.
If I were to ask you to look forward 30 years and sort of do an exercise, if you were king for a day and you could describe what the economy and the financial sector in 2048 should look like, what would the role of the financial sector be? What would the relative size of the financial sector in the context of the overall economy look like? Change is hard and it takes a long time, but if you could sort of wave the magic wand and describe where you think it should go, what would it look like?
Well, I would start by telling you, from the aggregate point of view, I would put more discipline into our monetary and fiscal policy, because that sets the stage. I mean, the attitude sets the stage. But having said that, I do think that these institutions are not, they are too big. The universal bank is a danger in the sense that they are public utilities. They cannot fail. They cannot be subject to the market in a systematic way. So if I had my druthers, I would separate out, call it Glass-Steagall if you will, I don't care. I would do that. Adam Smith says specialization is good.
Right.
It's, and I would have commercial banks be commercial banks, capital markets be capital markets. I think that would then drive some of the size back. I would I would demand more capital. I would make it more equity-based so that you have more accountability to the private sector and less to the public. I think that would be a real plus. And in that environment, you know, I had an individual from the manufacturing sector, this long conversation, you know, it used to be before they became universal banks and the derivatives book became such a trading activity on its own, that the banking industry served industry, industrial companies and manufacturing and so forth. Now we serve them. So I would make them more, I'd break them up, make them more manageable, and I think they would then serve our industry again. And we're still going to have cycles, but I think we would have less severe ones, and I think we would have more attention to lending, and our derivatives book would be truly for hedging and not for speculation, and we might have a much stronger, more vibrant, more exciting economic system overall, with real growth of 3% again, and with the distribution of income not quite so skewed. I mean, the amount of our wealth that is now, you know the numbers better than I do, taken up by the financial sector is probably twice what it was when I started in 1973.
It's getting close to 30%, I think, in some areas.
Which is enormous for an economic system like ours. That should be reversed over time. And I think simplifying the structure is a way. You know, I think
You would also reduce the political power, right? It's a big
absolutely.
separate
I mean,
sector,
one of
right?
the advantages of the U.S. Over these 200 years is we had a very decentralized financial system. And when if you looked at that chart that I gave you, the second one, and the distribution of assets managed in the banking system was about a third, a third, a third. A third to the Wall Street, large ones, third to the regionals, and third to the community. Now it's 80-20, 80 being in the largest banks, 20 being everyone else. I don't know that that's really been as beneficial as some people would like you to believe.
Beneficial for them, right?
Well, of course, but beneficial to our economic system, I don't think it's been as good as many people would like us to believe. I don't know, you know, Tom, you can't go back, I've been told that, and that's probably right. But if we don't, then we'll have a European model, we'll have 4 banks. Or Canadian model, we'll have 4 banks.
And how dynamic is
Right.
their economy, right?
And when you see this issue we brought up earlier, the branching, the only part of the industry branching are the largest to get access to those retail deposits, those low cost deposits. That's what I think we'll see going forward if we don't make changes.
I will tell a story that, you know, back in 1991 when they did the big Treasury Blueprint report.
Oh, yes.
Which proposed, among other things, repealing Glass-Steagall. And I went to an event that they were presenting this, and I knew the fellow who was in the chief of staff for the Treasury a little bit, and he was giving the talking points about, you know, this is more diversification, we're spreading risk, you know, we're economies of scale, economies of scope, diversification is good, specialization is a has-been. And at one point I put my hand and I said, you know what the most diversified organization in the world today is? And he said, no, what is it? And I said, the Soviet Union, how well are they doing? And he looked at me like it never occurred to him. It never occurred to him that this diversified, controls everything, tries to run everything, could possibly be wrong, you know? And
Now, it sells well when you say, we'll take care of all your needs.
right. Jerry, how are we doing on time? Do we have time for another question or two?
I think so.
Okay.
From European perspective, U.S. bank bailouts are a success story. I know it's weird to say, but if you take a look at the draft report, the SSD program report, all the money spent on bailouts was paying back and with interest. So actually, the federal government earned money on the bank bailouts, and the money was paid back as early as 2010. And Europe was still struggling with the financial crisis, with the international sudden debt crisis. When we take a look at other programs, for example, the temporary So that was a fully privately funded bank bailout solution, because the participating banks paid the fee, and the whole money was provided by the investor. So I think one very important aspect of the US system was that there were so many different approaches and different tools used simultaneously, and I think this diverse approach was one of the success elements. My question is whether, because when we talk about bank bailouts, we usually don't mention that each and every case was very, very different. So just to mention an example, illiquidity-induced bank bailouts are totally different from insolvency-induced bank bailouts, which are the majority program in Europe still currently. So do you see any difference in terms of how to approach those two different types of programs?
Well, you may be right that they were different, but for example, you mentioned the FDIC's liquidity program. The fund is, the cash for the fund comes from the banking industry, but the FDIC was technically insolvent at that point, and the guarantee is no value unless you believe the federal government is behind it. So it wasn't really a private solution, it was a public solution.
And how was the guarantee priced in your view? Was it really priced at a market rate or anything?
Well, it was priced, I will give Sheila Bair credit here. She insisted, it wasn't going to be priced properly, but she insisted on the price, which gave a return back.
Right.
But, you know, if you think about it, and then the money was all paid back, but the money was paid back at a far less market return than what it should have been paid. Because you had, this was truly a hedge fund, high-risk endeavor that the government took on for low-risk returns. So, which is fine. I mean, that's what your government's there is doing, but that's still a bailout.
One interesting comparison is that when Warren Buffett made his investment in the Goldman Sachs,
Right.
he got a 10% dividend.
Right.
The TARP payback was only 5%.
Right. Yeah, I mean, it was just, and so that's what government's doing, but I don't know that government should. If you had more equity into it, then I think you may not have had to have that much backing, number one. And I think, number two, it would, when you go forward, it means that you will change behavior. That is, you will change your risk profile of your institution because you know that you are now on the hook for it, not the federal government, and as creditors as well. Europe, how they chose to do it, you know, I'm not going to try and second guess, but I think one thing they have not done is insist that their banks get their loans written down. I mean, 3 years ago, they still had $1 trillion of legacy problem assets, and they have not insisted that their equity come up. There's still 200 basis points in real tangible equity below the United States. So, I mean, that's their choice, but I think it has some negative consequences.
So you have a lot of evergreening going on of zombie loans.
Yes, that's my point. So,
I mean, that's what Japan did. Look what it's cost them. I mean,
no, it's been a very slow growth, and that's my point. You don't just see it in the crisis, you see it in the slower growth over time, which is devastating effects on wealth building.
Because those loans then are not made to healthy, thriving,
No, they just
expanding
carried on on losing propositions. There's one last question right here.
Yes. I wanted to find out your opinion. I know when banks are insolvent, you can either use taxpayers' money to aid the bank
Right.
or nationalize the bank, that is transfer ownership from the private sector to the public sector. In your opinion, consider the pros and cons of either approach, knowing how taxpayers are protected.
Well, I don't think you should be transferring these banks to the public sector. That just makes a bad problem worse.
RBS would be a good example.
Right, it just never gets solved. So you do need to, and in the Continental example that I gave you, the government did take it over. The FDIC did own it and run it, and they chose the board of directors. But their principal goal was to get it back into private sector hands as quickly, so they did basically a sell-off at that point. So, now, you have to have banks that can do that over time, but I don't think you want, you get politics involved with, when it's state-owned, you get politics involved, you get what I call allocation of credit based on favors rather than on the market itself.
Terrific.
Thank you all. Thank you all very much.
Thank you. Thank you.